Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the series of discussion on CPF. This video, I'm going to explain why timing is crucial when you actually plan to do a CPF contribution or CPF withdrawal. So in short, this video, I'm going to explain when is the best time in a month, to put your CPF contribution or maybe to withdraw your CPF. So basically, this will be the objective of this video. Next, I'm going to explain the key difference between yearly compounding and also monthly compounding. So stay tuned over here to see more on this discussion. For our bank accounts, we usually receive our interest in a monthly basis. This simply means that the interest will typically be credited into our account by either the end of the month or the start of the following month. All this depend on the banks. This simply means that our interest is compound in a monthly basis. However, this is actually not the case for our CPF interest. For our CPF account, interest in fact is calculated in a monthly basis and they actually compound annually. Compound annually means that the interest is actually paid once a year, and for CPF, typically they will pay on the next year, 1st of January. How is CPF interest rate actually compute every month? So in fact, I have done this video. Okay, so in this video, I gave you some example how to compute your CPF interest rate. But let me quickly just mention a few pointer how CPF interest rate will be computed in a monthly basis so that later on you can appreciate when will be the best time to contribute or withdraw your CPF in a month. So basically, let me continue. So as I mentioned, CPF interest is in fact compute in a monthly basis. So instead of using the average balance of the month, okay, so in fact, bank actually do the average balance of the month, but for CPF, they actually use the lowest balance of the month. Let's say January, okay, from the 1st of January all the way to the 31st of January, they will look out for the lowest balance and there they will calculate the interest rate based on this lowest balance of the month. Okay, so with this case, this simply means that any withdrawal or deduction that you actually make in the middle of the month, they will not earn any interest in that given month. Okay, because they use the lowest balance. So even withdrawal or deduction, okay, so that particular withdrawal become the lowest. So therefore, whatever amount that you withdraw or deduct, they will not earn any interest at all. Similar, okay, so basically any contribution, which means that you do a top up, etc., that you actually receive that month, okay, they will only start to earn interest on the next month. Based on my last slide of discussion, now I like to do a conclusion. When will be the best time for you to contribute? Let's say in the month, when will be the best day that you actually do your CPF contribution? So for contribution, it will be ideal if you do it at the end of the month. Why? Okay, so even if you do it at the start of the month, you are not able to earn the interest based on the contribution. So therefore, in this case here, rather than put inside the CPF, you can consider to put into banks, okay, because banks actually compute the interest in an average manner. So if you put your contribution, okay, at the bank, that will earn you some interest. Just before the end of the month, a couple of days at the end of the month, then withdraw from the banks and then make a CPF contribution. So this is actually for contribution. But I like to warn you guys, please do not do this on the last day of the month. Why? Because they sometimes, in fact, may require to process this contribution. If let's say that you miss this last day of the month, it becomes the start of the month, then you probably will make some loss. So basically, this is for the contribution. Next, on the withdrawal, when will be the ideal period? Okay, so basically for withdrawal, the ideal period will be the start of the month. Okay, why again? So if let's say you are able to withdraw at the start of the month, let's say again, if you are able to put the money into the bank, again, that will earn you some interest. Okay, so rather than withdraw at the end of the month, if let's say that you withdraw at the start of the month, if you put the money inside the bank, that will earn you some form of interest. Let me do a quick conclusion. Let's say that you plan to do some form of contribution or withdrawal in these 3 months, Jan, February, and March. When will be the ideal case? So for contribution, okay, remember, okay, the ideal period will be at the end of the month. So basically, you can consider to contribute at the end of January. Okay, why? Because at March, you are able to earn the interest that you actually contribute. So therefore, if you are able to contribute at the end of the month as early as possible, then you are able to earn, for this case here, Fed can earn the interest rate of your contribution. March also can earn the interest rate of your contribution. Next will be on withdrawal. Okay, when will be the best time to withdraw? So if you take a look over here, the best time to do a withdrawal will be the start of the month. So basically, in these 3 months, again, I will recommend you to withdraw as early as possible in the month of the March. Okay, why? If let's say that you do a withdrawal in Jan or you did a withdrawal in February, let's say that you did a withdrawal in Jan, then at Jan, okay, you will not be able to earn the interest on the amount of withdrawal. Same for February and same for March. So therefore, if you withdraw at the start of the March, then in Jan and in Feb, you are able to earn the particular money that you intend to withdraw. So basically, this is the ideal time in these 3 months, okay, Jan, February, and March, for the contribution and also for the withdrawal. Next, let me show you the difference between yearly compounding and monthly compounding. Let's assume this case. Let's assume that you have 50K in your OA, and currently 2026 OA actually earn you a 2.5 interest. So now let me highlight the key difference between yearly compounding and monthly compounding. Let's say that this is for yearly compounding, which means that every month, okay, your money still remain 50,000. So at the end of the year, okay, they basically compute, let's say 2.5% for $50,000, they actually earn you 1.25K. So basically, this will be the interest that you earn with 50,000 inside your OA that earn 2.5% of interest. So this is for the yearly compounding. Next, let me move on to the monthly compounding. Okay, so for example, in a Jan, you have 50K in your OA that earn you 2.5 interest. So basically, this immediately start to earn some form of interest. If you do a calculation, 2.5 multiplied by 50,000 here, basically you can see that the interest for 1 month will be equals to 104.16. And then this amount will add to the 50K, as you can see from here. And you can see that this is actually a cumulative effect. So finally, at the end of the year, same position here. So from here, you can see that the money compounding will allow you to earn more interest as compared to the yearly compounding. So basically, this is the calculation of CPF. Okay, although they never pay you every month, however, at the end of the year, okay, they will compute all the amount, and this will be the total interest that you earn for your CPF contribution of 50K, okay, that earn 2.5%. Hopefully, with this, you are clear to highlight the key difference between yearly compounding and monthly compounding. A quick disclaimer: I am not a licensed financial advice. This video is for entertainment and education purpose only and should not be considered financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, let's continue the discussion. But before, I would like to urge you guys to help me by like this video. When more of you guys actually help me to like this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, and if you have learned something from this video, hope you can support me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for strong support. Now, I'd like to explain the common misconceptions about CPF interest rate. So, in fact, there are 8 of them. Okay, so especially this number 2. Okay, so this misconception on number 2, this in fact will surprise many people. Let me come to the first misconception. The first 60K, which I explained early on. Okay, before you reach the age of 55, okay, basically you will be able to enjoy 1%. For some, they thought that this first 60K is actually applicable to all the account, which means that this OA will enjoy the first 60K. The SA will also enjoy the first 60K, while the MA is also enjoy the first 60K. But in fact, this is totally wrong. So this first 60K is actually applied to all the CPF account, which means that they all add up. And in fact, OA only quantify only maximum 20K. So this is the first misconception. Like I mentioned earlier on, this probably will surprise many people. Whatever that you earn extra, okay, on the OA interest, they don't actually credit into your OA account. Like I mentioned earlier on, let's say that this OA actually enjoy this extra 1% interest. However, this 1% interest, they will not credit into your OA. They will credit either to your SA, if let's say you are before age 55, or credit into your RA if you are 55 and above, rather than credit into your OA account. So this may in fact surprise many people. Misconcept number 3 and also number 4. Okay, so the interest in fact for CPF, they are compute in a money basis, but they only credit once a year. Okay, so in fact, how CPF actually compute your interest is extensively discussed earlier on. They actually contribute based on your lowest balance during the month. For example, January, from the 1st of January all the way until 31st of January, they will get your lowest balance and use that to compute your interest rate. Then that will be so-called that particular month of interest rate. But okay, like I mentioned earlier on, you are only able to see your interest rate credit in a yearly basis, which means that at the end of the year, to be more precise, 1st January next year, then you are able to see your interest actually credit into your CPF. Next, timing matters more than most people actually realize. Okay, so a contribution, for example, you make a contribution in July. So in general, okay, you are only able to earn CPF interest from the following month. For this case here, then August onward, then you are able to earn this interest that you actually contribute in July. Likewise, if you withdraw the fund during a month, okay, so those funds that you actually withdraw, they in general do not earn any interest for that particular month. So this is why CPF members sometimes talk about this 1 month interest effect. Misconcept number 5. So when you are actually after age 55, the bonus interest even become more attractive. For example, for this case here, once you are 55 years old and above, you are able to enjoy extra 2% on the first 30K. And then you are also able to enjoy another extra 1% on the next 30K, which I have explained earlier on. So with this simply means that some CPF saving, in fact, will earn up to 6%, okay, at the RA. Basically, I don't think you have SA after the age 55. And also, you probably can earn 4.5% with your OA account. So from here, you can see that additional 2% on the RA and also the OA account. Next, the headline rate isn't always your effective rate. So for someone that is actually below 55 years old, and let's say this is an example that I mentioned early on. So for this particular case, the OA in fact can earn 1% additional. Okay, so instead of 2.5, it becomes 3.5. While for SA, okay, again, they are also able to enjoy another addition of 1%. So hence for SA, instead of 4%, it becomes 5%. Okay, so basically, a lot of people simply means that OA, in fact, will be just 2.5%, and SA will be, in fact, just 4%. And in fact, they have overlooked the higher effective return on their first 60K. Misconcept number 7. Your CPF life saving also qualified for this extra interest, which I explained earlier on. Before age 55, 1%. After age 55, either 2% or 1% additional. Next, the published rate are actually flawed. Okay, so a lot of people assume that OA will always be exactly 2.5%, and SA, MA, RA, they will be exactly 4%. In fact, this is totally wrong. So basically, these are so-called the floor or maybe the base interest rate. So basically, this will be reviewed in a quarterly basis. But the Singapore government actually guarantee this minimum rate when the formula would otherwise produce a lower rate. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.